Good morning, everybody. It's Mike with smartoptiontrading.com. You could also get a hold of me on Twitter at OptionsMike. I hope everybody's doing good as we've had a lot of volatility suddenly come into this marketplace. And I thought I'd take a couple minutes today and try to talk to you about this. So when you look at the S&P 500, last week we put a nice all-time high in on this chart. And we've had this big, beautiful move up, and then we came crashing down. And we actually got a 3% pullback in the marketplace. It may not look like it, but we actually came in 3%. And we broke through the 8 and the 21 days. And to me, when you get below the 21 day, it's a sign to be careful, take caution, be more strategic in what you want to be in, and raise your cash levels. I'm in pretty high level cash right now. We came all the way down to the 50-day where we bounced. And we had a big bounce yesterday. And as I'm sitting here this morning on Tuesday, futures are up big as we're going towards the open around 9 o'clock. So, the market has certainly become very volatile, very tough to deal with. One thing I do want you to notice on this chart is if we lose the 50-day, all those blue boxes below here, those are open gaps. So if this market decides it wants to come in, it could get a lot of voids. A gap is a pocket between in the chart where there wasn't a lot of volume trading. You can see there's 3 or 4 of these open below here if this market really wants to come in, come all the way down towards the 200-day. But for now, right now, we're back above the 21-day pre-market. And as long as we hold the 50-day, this market stays in play. I'm going to warn you, February is typically one of the roughest months of the year. Most of the times, February ends down. That's kind of an unusual little trait that most people don't know about for the month of February. And there's been a lot of talk about people, the market upset with GME and AMC, and I'm not really going to go into that. Those have been played out and talked about ad nauseum by everybody. But the market overall does not like when we get into wild speculation, and that's what we've been seeing here with the GMEs and the AMCs of the world. So if you switch from the SPY to the Qs, you can see here the Qs are actually holding in a little bit stronger, not a surprise. During the pandemic, tech was stronger, and with the virus kind of raging and the new mutation coming in here again, the tech industry remains strong. Microsoft delivered fabulous earnings. Tonight we get Google and Amazon. So the Qs are holding in stronger here as it's looking for tech to lead, and tech is typically the leader. You can see the Qs never got down to the 50-day, very strong there. This is good for us. This is good for the markets. I know from a personal perspective, I love to be active in the markets when tech is leading. And right now, tech looks great. As long as it holds above the 21-day, you can see we dipped below it for one session, but already went right back up. This is a really good sign for the markets as we go forward. So how do you play this? For me, I have my cash levels highs right now. And one of the things that I keep looking at is the VIX. The VIX is the volatility index. And what the VIX here is showing us is that low volatility environment that we had from 2016 through beginning of last year, it's gone. And now we've set this new environment that we're trading at a higher level of volatility. You can see that open gap down there around 2250 has never been completely filled. And every time the VIX gets down to 20, we bounce off of it. What's important to know now is we rocketed up last week. We're holding over the 30 area on the VIX and over the 200-day on it. So right now, this is a very strong move on the VIX. We should keep an eye on this. As long as it holds over the 200-day, the VIX remains in play for a move higher. This is something everybody needs to pay attention to, because if the VIX starts to go, the markets typically come down, and we really haven't had a sentiment flush in this market. If you take last week's trading and the pullback we got, the 3% pullback, which is nothing, you can see we really haven't gotten that far. And the last chart I want to share with you guys is the put to call index. This is an overall reading of the put to call in the market, and you can see these 2 blue lines. When you're over the top blue line, over 1, the market is bulled up. Typically, you look for a sentiment flush to get long. When the market's below the lower blue line underneath 1, the market's bearish, and that means that we're looking for a reversal for people to get long. One thing you notice about this chart when you look at it is for the last year, we have been stuck in what I call FOMO mode. That's fear of missing out. This is where the market is so afraid of missing out, they keep buying calls and calls and calls. And even the slightest dips in the market get bought back by the dip, right? You keep hearing that, buy the dip, buy the dip. So far, that's holding true. I believe for this character to change, this market to change character, you need to get a flush in sentiment. We need to get a big sentiment flush, knock some of this bullishness that's been pervasive in this market for the last year. Then we can get some very nice setups in this market. So for me, I'm being very tactical right now, keeping high levels of cash until we can get a better read on this market. And hopefully, I'd love to see a sentiment flush, knock some of this bullishness out of this market, and then we'll see where we can go from there. Anyway, this is Mike with smartoptiontrading.com. If you like what I'm saying, come on over and visit me. If you want to find out more, just follow me on Twitter at OptionsMike. I'm active there every day.